Hey everybody, welcome to Money Law. My name's Yashasaba, and this is the second episode of our series on taking you through the decade for your financial well-being. Basically, at every stage of your life, what do you need to think about in order to have financial literacy and security for you and your loved ones? This episode, we're going to talk about the age of 21 through 30. That is a very big, fun decade, but you don't have a lot of money. So what can you do to protect yourself now and put yourself on the right footing for the future? Real quick though, disclaimer! I'm an attorney licensed in California. I can only give legal advice to my clients here in California. You are not my client. Nothing on this video is legal advice. This is all education. I want to help you. I want to help the world. I want you to succeed. So if you like to succeed, keep watching. So by the time you are past the age of 21, most people, you're still getting your education. This is around the time you are graduating from college. Congratulations, you did it. You're either graduating from community college, transferring in, you're going to grad school, or you're going to start your real job. First thing you want to think about when you finish your education, your student loans. What happens next? Are you just going to start paying them? I can't tell you how many millennials tell me that, oh, I'm on a low income plan, so I'm just paying this small little itty bitty amount, a few $100s on the student loans that they have, about $20,000, $50,000, $200,000. And they don't realize that all they're paying is just the interest. They're not hitting that principal. So if you have student loans and you're coming out of college, first thing you gotta do, refinance. Yeah. What does it mean to refinance? It means you are finding another bank to pay off your current loans, get off the government loans. Those interest rates are 4 to 6.9%, so high. When you refinance today's market rate, 2.75, 3%, 4% and lower fundamentally, you are saving so much money on your monthly payment. You are lowering your expenses. You're giving yourself a timeline to pay off your loans, and you are hitting that principal faster than if you stayed on the government's plan, where the government doesn't want you to pay off those loans. They want to make your money. So refinancing takes a little bit of strategy. You need to consider your credit score. In the last episode, we talked all about downloading a credit score app, so I'm not going to go into that now. Here's another strategy. When you go to any bank and you want to refinance your student loans, they're going to want to know two things from you. How much money do you make? How much liquidity do you have? And what is your credit score? These are the three biggest factors that determine what good of an interest rate you get on that refinance. Okay? So if you want to make sure you have liquidity, maybe ask mom and dad to put some money in a savings account, where you promise to them you're never going to touch that money. But as long as that money is in your name, even if it's in their name, for at least 4 to 6 months, when the bank asks you to, hey, show us all the money you have in your accounts, you show them the savings account that mom and dad put a large chunk of cash in for you. And they see that, that increases your liquidity. So even if you're not making a high income, where the bank might feel comfortable, or even if you're in a risky job, maybe you're just starting your career, you don't really have a job that shows it's gonna pay, so it's gonna be hard for a private bank to want to give you a loan. The liquidity is what settles their differences, okay? So focus on getting a job, making sure you are paying attention to your credit score, and see if your parents can allow you to have some kind of money saved. That is a privilege, and if your parents do that for you, thank them a lot, okay? Next, we did jump ahead about talking about refinancing your student loans and the importance of that, but really what's probably top of your mind is, where am I gonna get my first job? On average, it takes about 9 months for students, graduates, to get their first job. It is taking a lot more time for people to land a job. Now, some majors, obviously, they're gonna have a job within a week. Some majors are gonna have a job within a month. Not everybody has that luxury. And the average time it takes for the average American, no matter what age you are, to find a new job has been 9 months pretty consistently over the last decade. So I would plan a strategy with your family and you in terms of your finances, your expenses, your costs. Just assume you won't have a job coming out of college until then. So if you want to start early, the time to start is not when you graduate for looking for jobs. It's when you start your senior year. Start looking for jobs then. Look for those internships, because those internships convert into jobs. When you graduate, most of the internships are gone because they're taken by the students that acted first. and you didn't. Too bad, but don't worry, you're not screwed. You can still find a job, it'll happen eventually. Your first job, you're not gonna like. I guarantee you, it will be a job you hate. If you are lucky enough to find your dream job on the first try, good for you. That's not everybody, so pat yourself on the back. But if you're still looking for a job today, keep looking, follow your heart, go see where you wanna work, follow your talent skills, and see what you like working on. And then right once you find that job, this doesn't mean you get to go on a Vegas vacation. This doesn't mean you get to buy that Louis Vuitton purse. The people that do that really early in life, I guarantee you, these are the people that are not gonna have money in life unless those items are being paid for by someone else. When you start your first job, start saving your money. Remember the rule of thumb, save 30%, invest 30%, spend the rest. Right once you get into that habit, and what I tell all my clients, my young clients that are succeeding today, what we do is when they get their job, from their paycheck, instead of it going straight into their checking account, we tell HR, go ahead and pay this other account, a savings account, this percentage of the paycheck, no matter what it is. If it's commission, if it's a solid salary, if it's hourly, it doesn't matter. This percentage goes that way. That way, you're not relying on yourself, on your own habits, whether they're good or bad, to move money into savings. It's automatically happening for you. When you do that, I guarantee you, you will save so much money that you will be ready to buy a house in your 30s, the next decade, next episode. So keep that in mind. The moment you start your job, don't just say, I'm gonna save money. Bullshit, you're not gonna do it. I know you better. It's not gonna happen. I've seen so many people, it just doesn't happen. You go to HR and you make your payroll, your paycheck go one way to your checking account, another way to savings, 30% to savings, 30% to investing, that can go into your checking, invested in Robinhood, free commissions, and then the rest you can spend on whatever your heart desires, as long as you're putting that 30% away and not touching it. Finally, the next thing, obviously 21 through 30 is a very big decade. A lot can happen, and I wanna focus on the key fundamental financial measures that are really gonna set you up right. So we talked about student loans, we talked about you getting your first job. The next thing you're probably itching to get at is moving out of the house and finding a place for yourself. Do you have enough money to buy your own home or condo or apartment? Probably not. So you're probably gonna start renting. There's two things I want you to consider. First, when you rent, always keep in mind that is not saving or investing. That's neither. Because when you rent from somebody else, someone else owns the property, so that is spending. So if you're gonna rent and you're doing that kind of easy 30% saving, 30% investing, and the rest goes to spending, rent goes as an expense towards spending because it's a black hole. You'll never get that money back. And if you wanna be able to grow fast so that you can live a cushy life when you're 40, you can live a glorious life when you're 50, it starts when you're 20. So maybe consider working with family to support you with a down payment. Your parents might not be able to support you that much. So another thing to consider is a first-time home buyer loan. A lot of people don't like these loans because they kind of add a premium to your interest rate. When we talk about first-time home buyer, the federal government has something called FHA, first-time home buyer loans, of up to $800,000 or less, depending on where you live, what state you're in, your income level. When you're starting out, just graduating college, you have no income. Your income is gonna be shit. It's gonna be 40%, $40,000, $20,000, $60,000 if you're lucky, $75,000, $90,000 if you chose a very good degree and you chose good internships and you've got great skill sets. But even then, that's still not a lot of money in this world. I'm sorry to say, it sucks, right? So when you start saving your money, as you should be doing, that 30%, then all of a sudden, for a first-time homebuyer loan, you only need 3.5% of the purchase price of the property. So if you want to buy a home that's maybe $600,000, $400,000, you don't need to get 20% down, which is kind of the standard rate across the country on how much you need for a down payment to get a loan from a bank. With a first-time homebuyer loan, you can get a 3.5% down payment. Your interest rate will be market rate, but there is a premium. That premium, it's mortgage insurance. It's about 1 to 1.2% added onto your interest rates. So there's a lot of banks, a lot of brokers right now. I really don't get it why. They're not focused on you. When they see that you want to buy a house, they say you can get a better deal, a better rate, not doing an FHA loan, but just doing a regular loan with 20% down. But then you're saying, shoot, I'm really cut out of the market because I don't have that kind of money saved and the housing prices are going up. But right now we are in a low interest environment. And FHA loans are still market rate loans. They just have a little premium on the interest because you're a first-time home buyer. And nothing says you're gonna be stuck in that loan forever. So the goal is get into a house, get into ownership. When you own, every payment you make is like saving and investing because you're building equity on that home. So every payment you make goes into the home. Some of it goes to the bank, you'll never see it again, but rent, all of it goes to the bank. Here, some of it goes to your principal, which means if you want to move again, not only are you saving money, you're also building a savings in your own home. That is so important down the road when you want to level up, move into a larger house. As prices are going to go up, you're not in a rat race anymore because you made the smart move of feeling a small financial squeeze from that somewhat high interest rate, paying little money down, so less risk for you, and starting your life as a homeowner, where you can start writing off the interest you pay on the loan itself, on your taxes. Much better opportunities for owners than renters in this world. That's just the hands down reality of life, okay? Now, if you don't have that money, consider instead of investing, saving more, right? And when we say savings, that 30%, that includes retirement savings too. So if you want to save for a home and retirement, that 30%, you might have some of that investment act as your home savings. Your savings gets invested as well, but the point what we mean by investment is don't look at those investments as savings, look at those as high risk. So as long as you're saving 30% of your income, maxing out your retirement accounts. We talked about Roth IRAs, 401ks in the last video, a little early in your life, but important to know now rather than later. And then open a Robinhood, a brokerage account, commission-free, they all exist, and start investing in stock. But realize this is high risk. You are gonna make a lot of mistakes. Guaranteed, you won't know what to do until you go through the mistakes, until you have your own philosophy of the market and how you think investing is gonna work. So that is not a savings account. In fact, that's very high risk. If you're using that as your down payment for your home, good luck. Some of you will succeed, the rest of you will fail, in my opinion. Now, after all of that, when you wanna move out, let's say you can't afford a down payment, but you want independence from your parents, you can rent, yes. But if you're gonna rent, I know it sucks. You had roommates in college. You might still need some roommates today. Another thing to consider is what if you were the one that used that FHA loan to buy that house, that first time homebuyer house, go in the outskirts, don't go in the city, you go in the suburbs, but then you fill your home with renters. Do you know what we call this? We call this house hacking, where now your mortgage for that FHA loan with that premium interest is being paid by your renters. So you don't pay anything. You might not make a profit. The goal is not to make a profit. The goal is to lower your expenses while you have student loans, while you have a mortgage to pay, and while you have car payments and all that, whatever your expenses are, you can become independent faster by letting roommates come and live in your home, whether it's one or two, and then you are on the fast track to making money. So that's it for today on Money Law. I'm Yasha Saba. If you really like what you're learning from the last episode and this one, we've got a lot more episodes coming talking about how your life is going to be affected financially through the decades. So go ahead and subscribe to our channel or follow me on LinkedIn. I do post a lot of other content there. Say hello. And the next episode, we're gonna talk about the age of 31 to 40, where really your life begins. So go ahead and subscribe. Don't forget, I'm on LinkedIn as well. I put a lot of this content out there, so you can follow me on LinkedIn, say hello, and then, oh, I forgot what I was gonna say. Oh, the next episode.